So since the market's not open today, I wanted to talk about something pretty important that actually pretty much gave me a revelation in the first half of the year. It's dealing with risk management, which we all know is extremely important when it comes to managing trades and being successful at this kind of thing. So what I want to talk about today is position correlation. A lot of times, like, people have a rule of thumb that they would say something like, here, I'll give you one of my old ones. I would just say, I will risk no more than 100 bucks on a trade. Okay, pretty easy rule, and I would follow that. So I would look for trades and I'd keep going. So I'd like say, okay, there's a triangle here, I could take advantage of that. There's a head and shoulders there, I can take advantage of that. Head and shoulders there, I can do the same exact thing. And I just go through a bunch of different stocks. And I would build up my portfolio and make an array of things that I could trade. Now, the problem that I found was that very often the trades that you make, the individual stocks, their movement is extremely correlated to the market and extremely correlated to each other. So instead of saying I will risk no more than $100 on a trade, I really had, let's say I did 10 trades, I really had 10 trades risking $100 each, and they were correlated, so in fact I was risking $1,000. Now, that's not so much a problem if they're not correlated, but the fact was I would have these 10 trades, and because their movement is, I can't find another word, linked to the movement of something else that I was also trading, instead of losing, say, $100 on a trade, let's say we have a big down day and I had 10 positions that were correlated that I bought. And when one went down, that probably means that the other 9 of them went down. So I had all 10 trades, all losing the same day and getting stopped out, losing $100 in each one. It's kind of painful. The idea is you're saying, okay, I'm making small trades and I'm managing my risk, but really you're making one huge trade and taking huge risks. So this is an exercise that you could do with different your portfolios that you have, and I just did this quickly. I have I have a little model portfolio of JP Morgan, the Dow, dry ships, and everyone's favorite, Apple. So this is just a historical plot from the beginning of this year, so January 3rd was the first trading day, to the present, and I took the I took the prices and I calculated correlations of each one to each one. Now, of course, you don't see me doing JP Morgan to DIA and then doing DIA to JP because they'd be pretty much the same. But the idea of this is to say, if I'm doing 2 trades at once and they are highly correlated, perhaps I want to do something different. So, for instance, if we zoom in here, we have JP Morgan to the Dow. Let's say that I want to buy both JP Morgan and the Dow. That's a really high correlation. Like, I'm saying anything above 0.7 or 0.6, that should raise a red flag. So I say, okay, JP Morgan and the Dow, they move together. That actually makes sense because JP Morgan's in the Dow index. So I would say something like, okay, I'm not going to do both. I'm either going to trade JP Morgan or the Dow. So if I just set the arbitrary mark at, let's say max correlation equals 0.6, and that's the most that I will take. I'll just make that a hard and fast rule. I would say, okay, also, JP Morgan looks pretty darn correlated to dry ships, so that one I will not do either. So we're going to fade those out to gray, so we won't do these. But then I look at JP Morgan Apple. Wow, that's not really correlated too much. Not too much like a risk between each other. So if I do want to trade JP Morgan and Apple, okay, sure, buy them both. it's not going to matter as much as these other two. So then I did the next one, like DIA to dry ships. That's pretty it's pretty highly correlated, so I wouldn't trade them both. But the Dow to Apple, okay, if I want to buy both Dow and Apple, or short both Dow and Apple, that's fine, so I'll leave that one there. And then finally we have dry ships to Apple, and this one's really low. So that means that if I want to trade in the same direction, both dry ships and Apple, that's fine, because they're going to move independently of each other, or at least so the last 6 months said. So that's a way that you can really help manage the risk on your portfolio to make sure that you don't turn multiple little trades into just one big trade with one huge risk. So that's a little tip that you can do, a little exercise to do your portfolio analysis, and you can get like historical prices off of yahoo.com, and correlation to get it, it's actually use the function equals CORREL, and then you choose both the data sets. Alright, so little method for you. Okay, thanks for watching, and if you haven't already, make sure you subscribe to the newsletter. It's coming out on Sunday.